Hello and welcome to 10 Days Before Christmas. What are you giving and what is in your stocking? That's the question you might be asking here on this December 15th. Hopefully, you had a great weekend. We had quite a bit of family activities. Spoke yesterday in church, and hopefully, they'll come back next week. Well, maybe they shouldn't ask me to speak. All right, so a little fun there. We'd like to welcome, we got Rachel Dasher with us in the chat. We welcome her. She's on the East Coast. I'm in Salt Lake City, Utah. We welcome everyone here today. We got Bill. We got JP with us. BB, Bill Bornhoff with us, or Double B from now on. Amanda with us, Jessica, and many others. Welcome to all. Now remember, we do post educational content on X. I'll share with you a post here that we're going to be using today and tomorrow. I'd really like to use today and tomorrow. Tomorrow being 11 a.m. Eastern time. I'm not supposed to be in tomorrow, but I'm going to plan on doing it anyway. Okay. And I want to kind of use this class and tomorrow morning's class as a way to kind of start the portfolio over for 2026. I'll talk about why on the other side of kind of some of the disclosures. Now, just real quick, remember that with what we discuss here, it's done for general informational purposes only. Should not be considered an individualized recommendation or endorsement of any personalized investment advice. Also remember, when we talk about some of the strategies, those might not be suitable for you. You might choose something else. That's fine. That's up to you. Now also remember that options carry a high level of risk, not suitable for all investors. Important to understand that not all options are the same, okay? And so there's some difference there. Be aware of that. There's also what's called the characteristics and risks of standardized options. I've read the whole thing front to back. Very interesting. And be aware of what those risks are for different types of options. Also remember, when we talk about examples, the paper money software applications for educational purposes only, investing involves risk, including loss of principal. And today what I want to kind of do is we'll take a quick look at the markets, sectors, but really what we want to do is kind of talk about kind of closing down shop, so to say, for 2025. And then 2026, we're going to kind of start up here today. So you might be thinking, well, why are you closing down shop? Okay. When you say closing down shop, what do you mean by that? Well, last year, I think we got started a week prior to Christmas, and we restarted the portfolio like December 18th-ish or 16th-ish, somewhere right around there, a week before Christmas. And that way, if some of you were gone for Christmas or New Year's, etc., we had the portfolio going. Okay, we didn't start the first of the year and then talk about what we're going to kind of do. So I want to kind of do that now. So first off, so we're going to kind of hop right in just real quick to, now before I go into the markets, I want to kind of just go into, let's say, now you should be thinking now you're at year end. Where are you? Where have you been? Where did you start? And so on. Now I want to imagine that a portfolio started at, let's say, 107,000. Okay. So where did you start? I want to imagine hypothetically that a portfolio went down to 91,000. Okay? Can anyone actually tell me how much of a drawdown that was? Now, why is that important? Well, the reason why this is really important is because it's not just about potential plus or minus returns. You should be really looking at kind of the drawdown and the risk that you were taking or had to take or maybe did take while you're in those positions, and just kind of think about the volatility in the portfolio balance. So if we did this, all we're going to do is we're going to take 91,000 divided by 107 minus 1. And that's going to give us a percentage. And that percentage, if I do this, I want to kind of see if hypothetically, if the account started at 107, which it didn't, and it went down to 91, okay? If I did that math per that sheet at the bottom, 91 divided by 107, okay, minus 1, the portfolio, hypothetically, given these numbers, was down 14, it was down 14.9%, okay? So it drew down, drawing down is actually just saying, look, if you started at 107, what percentage you go down from that starting point if you had started at 107? Now, let's say the portfolio, hypothetically, it's not, goes up to 138,000. All right, so now where are we now? Okay, hypothetically. Well, if we say, well, 138 is the ending value, hypothetically it's not. And now what we're actually going to do is say we start at 107. You're going to see in this case, we're just going to take the numbers, same numbers. The numerator is going to be the ending value or where you are currently. The denominator is where you started. -1, so you could actually get it to where, to break it down If you don't take -1, it's going to show you're at like 1.10. So you have to subtract the 1 off, even if you're negative. Now, if we did that, it's going to be 28, let's just say 28.9%. And these are hypothetical numbers, okay? Now, I want to kind of just make mention of something to you is if you said, example, if you said, I tend to like maybe put my portfolio over, let's say, let's just say 5 sectors in the S&P 500, you might be using, let's say, SPX as a benchmark. If you said, James, I tend to actually put my portfolio over 7 to 10 S&P 500 sectors, you actually might be using SPX EW, the equal weighted index. And if you actually said, James, I tend to just focus on large cap stocks that don't tend to actually really a lot of times be, let's say, technology based to some degree, you might be using Dow Jones. If you actually said, and I know people like this, I'm not making fun of people, but I know people that they do 100% technology. They're using a benchmark of the NASDAQ. They're comparing those returns to what they did. And if you said, now, I don't know anyone that said this to me, but if someone said, James, I do all small caps, they might be benchmarking completely to the Russell. Okay? Now, I think probably most of us here would probably be saying, James, I'm benchmarking to the SPX or the SPX EW for an equity portion of the portfolio, or if not entirely. Now, what this portfolio does not actually have or has had is when you look at this portfolio, it's really invested in 100% into stocks. And when I say 100% into stocks, I'm saying stocks and options. Now, I'm not saying you have to do that. But what I'm trying to really show you is by these percentages, down this much, up this much, these are hypothetical values, okay? Well, what that really means is it's kind of choosing a portfolio that's like way up here on the top right-hand side. You're trying to go for a higher percent, but to get that higher percent, you're actually maybe willing to actually have more down. You're willing to actually have a higher percentage drawdown for a potential higher upside potential, okay? Now, if you said, well, James, I don't do 100% in stocks or options, fine. Then you're going to try to move a little bit over here, and you might use things like fixed income. You might use things like ETFs. If you chose that, we don't do that in this class because that's not what this class is about, okay? But if you chose different asset classes, it's probably going to move that portfolio to the left, which means you're trying to take less risk while still getting some return. But this class, okay, is really about going out here on the right-hand side and being willing to trade and invest with 100%-ish pretty much in stocks and options, okay? Now, I just want to kind of give a little backdrop. So first step here is you should be thinking about where did you start? How deep did your portfolio go? What was the drawdown? And then also, where do you stand now? I gave hypothetical values so you could kind of practice evaluating for yourself. I also kind of gave benchmarks and said, well, what type of investor are you? What type of allocation do you have, right? And those are some benchmarks that some investors actually might use. Now, what I want to do is let's go back to just real quick to the paid money portfolio. Now, let's say the paid money portfolio, what I'm going to do in this case, before I go there, is we are going to establish, let's go back to that sheet of paper, okay? Now, I'm going to say that, let's say on the margin account, M for margin, we're going to use $40,000 to start with. $40,000, okay? Now, if someone says, is that a lot? It just really honestly depends, okay? I don't know, okay? I think most of us here might be 40-ish, somewhere ballpark, okay? If we took, and then if we said the IRA, I'm going to push that a little bit to the 150. Now, I don't think anyone would say, oh my gosh, filthy rich, okay? Probably doesn't feel rich. If you have 150, you probably don't feel filthy rich. So we're going to say M for the margin, 40,000, and you got the IRA, 150,000. Now, I like to kind of think of this as a model of 80-20. What do you mean 80-20? Well, 80% stocks, 20% options, okay? 80% stocks, 20% options, okay? 80-20. And so if we look at this, when we kind of look at the breakdown, it's going to give us about 32,000. Are you with me? it's going to give us about $32,000 of stocks, S. And if we said 40K, 20% of that is going to really be, in this case, well, it's going to be about 8,000. So if we did short put verticals, long call verticals, that's going to be in the option section. We're going to have about 8K in the options. And if we went down to the IRA, the 150,000, 80% stocks, 20% options. You don't have to do that. I'm just using an example. And it's going to be about what? 90? No, that's more. 80. Just want to verify my number here. 80 times 10. Okay, 120. A little higher. Now, it's going to give us, in this case, 120, okay, for the stocks. So if we go back to this, when we're setting up this portfolio right now, we're looking at 120, okay, stock, and we got really 30K that's going to be in options. So now I just want to kind of explain this. When we talk about stock, it's exactly what it sounds like. Now, if you said, James, I do something that is a group of stocks, then that would be in the stock basket, okay? If you said, well, James, wonder if I buy a stock and I maybe buy a put too, that's going to be in the stock basket. If the investor chooses something that's like a long call and a short put, like a long synthetic, that's in the option basket. Cash secured put, we're going to put in the stock basket. Why? Well, because it's the potential of owning the shares. Let me repeat that. The paid money account does a cash secured put, it's putting in the stock basket. Okay, because that's what it is. It's a potential ownership of the shares. Needs to be prepared to buy those shares prior to expiration, regardless whether it's in the money or not. If they did a long call vertical, option. Short put vertical, option. Short call vertical, option. Long put vertical, option. Okay? All right, there's the breakdown. Now, here's the thing. We're now going to go to this, and so I also want to kind of get a quick understanding. I want you to imagine you're a portfolio manager at JP Morgan, and you're up 29% for year end. Okay, you're up 29%. Now, with let's say 15 days left, you're probably doing everything you can to hold on to that. Does that make sense? Have you ever seen a football game where like there's 3 minutes left in the game and all of a sudden it's just like they're milking the clock, okay? They don't hike the ball until 2 seconds, right? Well, you get the same thing in the stock market, where all of a sudden kind of moves go up and then people profit take, or people are actually kind of, maybe the VIX is holding up a little higher or going up because people are trying to protect that percentage. They don't want to be up 29% hypothetically for the year. In the last 2 weeks, they actually give back 12% of it because the market falls back. They're trying to protect their gains and where it stands going into the new year. Does that make sense? All right. Now, here we go. So it only took 12 minutes to do that. So now what we're going to do is, very sad, we're going to go to the paper money cap. Now, this is where it's product. I mean, if you want to see James cry like on TV here's the chance, okay? So what we're going to do is going to go to the 3 lines. And what we're now going to do is say, in this case, we're going to go to, it's been a while. Oh, yeah, adjust account, okay? Go to adjust account. And what we're going to do is reset all balances and positions, okay? Click. Now, once we do that, it's going to wipe them all out, okay? So everything's zeros. Now, I haven't cried yet, but I could poke myself in the eye to cry. Now, what I'm going to do just real quick, if I go to the margin account, we're going to go to that account, adjust account, reset all balances and positions, apply. Now, if I look at this, if we do that, what does it kind of start us with? Well, it really is going to start us with, what do we got in the margin? We're going to have to probably adjust it just a smidge. Okay, it's 100. So we're going to go to where it says adjust account, and what we're going to say is reset all balances. No, not that. We're going to go to any one of these positions that we had. The keyword is had. Right-click on any of them. We're going to adjust cash. Now, you can't do this in real money. It would be nice, but you can't. I'm going to adjust cash, and what we're going to do in this case is we're going to go minus 60,000. Now, why minus 60,000? Because the balance in the margin account is 100 less 60. It's going to get us to our 40,000. Okay? Now, if we did that, press OK, there's the 40. Going to go to the IRA. Going to go back down to any one of these positions that we had from before. We're going to right-click on any of the positions we had. Say move to group. Adjust cash like we did on the previous one. And now what we're going to do in this case is going to go ahead and say, okay, we're going to add 50 here. Now, wouldn't this be nice if you could just type this in your real paper money account or real account? like the paper money, but it doesn't work like that. Click on OK. There it is. Okay, here we go. Now, I want to kind of take a step back for just a moment. Let's kind of look at this just really quick. So when we're talking about building that portfolio, okay? Now, by the way, if you said, James, if you said, what would you like to do if you could? Boy, that's an interesting question. Ooh, okay. Now, one thing I would like to kind of add is the group of stocks that we talk about on Fridays with Kevin. That would be nice. So remember, if I say stocks, you might say stocks and a group of stocks for you, okay? So when we talk about, obviously we're going to be doing stocks. Now that's going to be really doing, I'm going to use the word intermediate, okay? Intermediate. And when I say that, it's going to be weeks to months. When we say short term, we're going to say like days. When we say days, we're saying 2 to 3 days to, let's say, 2 to 3 weeks. We're just going to call this swing trade, okay? Or swing trade. So that's obviously a foundation. Now, with that foundation, we're going to also include with that cash secured pets. This is income with the potential to buy the stock at the strike price. Now, why do you put that with the stocks? It's because it could become shares, okay? Now, if we had stocks, we're going to be looking at, obviously, covered calls sometimes, and we hit on that last week. We're going to be thinking about things. Now, by the way, let me take the step. Let me move up just a sec. Married pets. When we say married puts, that is, and you're going to see one or two of those here today, long stock plus long put at same time, okay? Now, when would that be a strategy of interest? Simple. When the VIX is low and diverging. And I'll give you a little wink, like right now. Okay, little wink. I can't wink. It's hard. I'm trying to type at the same time. Diverging. Okay. Now, the reason why it's when the VIX is low, when the IV is low, the premiums for the puts tend to be lower, you got to verify. And so the lower the put premium is, the less the stock has to move to break even. Now, so that really 1, 2, 3, that's the foundation for the portfolio. Okay. We're also going to include with this covered calls, long stock, okay, plus short call. Now, this could actually be, let's say, buy right or leg in, okay? You do it at the same time, buy right, you get in the stock, and then later put the call on, leg in, caller, okay, very foundational, long stock, plus short call, plus long put. And you can kind of think of that like a vertical-like strategy. When I say vertical-like, it really, what do I mean by that? It just really has a max gain and max loss, okay? Now, that strategy, caller, is very interesting also when the VIX is low and diverging, okay? Now, when we get into some of these other strategies like a short put vertical, long call vertical, okay, and anything maybe where we're saying, hey, James, I want to do like a long synthetic, which is really just, it's a stock-like strategy, has an expiration, don't get the dividend, but you are trying to leverage, okay, the trend/momentum. So if someone said to kind of me, hey, when you're looking at the market and you're thinking about taking some bullish positions, boy, these are some strategies that probably the investor says I don't want to be a lightweight in terms of having an understanding. Now, last year I thought we did a decent job in terms of kind of practicing these strategies over and over and over again. By the way, over and over and over again ain't bad, okay? It's just getting some practice. Now, what I want to kind of do just real quick is I want to go to, let's look at some kind of things in the market right now and kind of break some of these down. Now, when we do this, I want to kind of us to think about the framework, okay? Like, in other words, if we're looking at the margin portfolio and the IRA, we're going to do sometimes the exact same trades, whether it's the margin, just on a smaller dollar amount, and also the same amount, same position and the IRA that's going to be at a higher dollar amount. Okay. Now, the other thing I want to kind of make sure we're crystal clear on is last week, let me go back to this. I posted, and I just want to make sure everyone has this at the beginning. I feel like we're at the first day of school. Hi, my name is James. I'll be your teacher. So you're going to now notice that last week, December 11th, and this is very important because we want to have the same tools, and we're going to talk about the same strategies, right? And we want to kind of have a foundation to go off. There, right there is the link for the updated charts. We've kind of been talking about some some charts over the last couple of weeks. We added one, and I'll kind of make mention of that here today. So how would we put that on? I don't want to spend a lot of time on this, but if I brought this up just briefly, go to setup, open shared item, and then what you're going to see is right there, okay? Now, what's really big about this is there's a lot of people that will talk about the market. Very few will actually go through day by day, week by week, month by month, quarter by quarter, year by year, and kind of talk about how to do example trades with kind of a set process in place, okay? Now, I want to be crystal clear here, okay? When we talk about 100% of the examples that we're going to look at are coming from the Dow Jones 30 stocks, NASDAQ 100, the S&P 100. Very rarely will we look at stocks in the S&P 100, S&P 500. You got to understand the S&P 500 stocks can also be some in the NASDAQ 100, S&P 100, and the Dow 30, okay? So the reason why we look at the S&P 500 stocks is because they have like casino-like stocks, home building type stocks, airline type stocks. But outside that, there's kind of a lot of overlap of what we get in the first three lists of the Dow 30, NASDAQ 100, and the S&P 100, okay? So the three areas, what are they again? Casinos, airlines, and home builders. Those are interesting in the S&P 500. Now, if I click on preview and then okay, it's going to show the list. It's going to show this graph, okay? Now, what I want to do is I want to kind of take a look at our first example, okay? And so when I kind of set up this first example, I want to go back to kind of just real quick to this. And I want to kind of, so remember I made the comment like the VIX is low and diverging. So one of the first things we do before we just jump in the water is kind of say, where is the VIX? And might that change the strategy? Sure, okay? Now, if we go look at the VIX, and what you're now going to notice is if I go to type in VIX, you're now going to see that if we look at the VIX and I zoom in, we are on this first chart right here, our standard 10-day whole moving average, okay, with the 20 period as well. And this is actually something that, you know, sometimes historically we've seen be a little dangerous, okay? What do we mean by that? Well, what you're going to notice is this is where the MACD was down to this deepest point. It's a little shallower, and what you're seeing is a little push to the upside, okay? So that right there, this is where we have the price, the VIX level, making a lower low. That's true, okay? Now, the big thing is also is if you have the VIX making a lower low and the oscillator going the opposite direction, one's going down, the other one's going up, that is your classic divergence. Now, if we go back to this little sheet of paper, that also might influence like what type of, like, say, sectors we pick, okay? If we're actually seeing, let's say, the VIX, and that VIX is starting to increase, man, those investors, they're probably going to look at, let's say, they're going to probably look at, let's say, staples. I'll put P for staples. R for, ticker. I'm going to put, let me just get the tickers here so we can be consistent. IXR, which is going to be staples, okay? Probably thinking about, are there areas like IXU utilities? Are there areas maybe like IXRE, which is real estate? We'll put a dollar sign in front of that. And they're probably actually thinking about dollar sign IXV, okay? So the left-hand side is really if the investor thinks the VIX is going to increase, okay? These are kind of what they would call the lower, some people call beta, lower IV, okay? Lower IV. They're also the ones that tend to have the dividends and so on. There's some fundamental points to that, but we won't go there. If we actually said the ones on the right-hand side, we think the VIX is going to decrease. We think the VIX is going to decrease. We're going to be looking at really IXT, which is going to be technology, discretionaries, okay, IXY, you might use some different tickers. I can't do that, okay? So I have to use indexes. So if we take a look at this, and if we said, well, what else? Well, you got technology, discretionaries. We're also going to include IXE, which is the energy, IXB, which is base materials. And if we kind of said somewhere in the middle, but still to the right-hand side, we are absolutely going to include IXI, the industrials. We're also going to, when we say industrials, we're going to include the Dow Jones transports, okay? And you're also going to see in this case, we're going to look at, let's say, the IXM financials, okay? Now, kind of draw a line. So we kind of talked about what do we want the volatility to do? What do we think it's going to do? Well, in this case, we actually probably think the volatility might try to increase a little bit. If we kind of look at, I call this delta scale, okay? So you could kind of think of this also like first, second, third, fourth, fifth gear in your car. Well, if you put your car in fifth gear, you're probably not going 10 miles an hour. But if you actually go out here and buy a stock position, you're in fifth gear, okay? You're in. If you buy a long synthetic, you're in, okay? You're committed. If someone actually says, James, I did like a short put vertical, a long call vertical, I'm just going to call this first gear. The delta is less. And when the delta is less, the gain or loss on a 1 point movement in the stock, it's not the same as owning the shares. The cash secured put, it's going to be right second gear, okay? If we actually said, hey, what is like a covered call? Third gear. Third gear, in this case, you have the shares, you sold the call. The one thing we actually also have to include, second gear, we're also going to say in this case, a caller position. And if we actually said, well, hey, you're missing one, the fourth gear. Fourth gear, for some investors, they might really say, like, James, I'm going to, let's say, buy like a long call, which we don't typically do a whole lot. But I'm also going to put long synthetic here as well. That's applicable to what we talk about. Why the distinction? Well, if you did the exact same strikes, it would be like a stock position in terms of the delta movement. But if the strikes were uneven, which they typically are, it's going to probably have like a fourth gear. The delta is probably going to be between about 70 to 90 or so. Okay. If you pick the exact same strikes, the delta is really going to be 100. Okay, it's 100 plus. Buy 100 shares of stock, 100 delta. The bigger the number of the bigger the number for the delta, the greater sensitivity to price change. Okay. Now, this is what goes through my mind. Okay. So if we think now, let's just ask everyone here: do you think the VIX is going to go up or down here? Where do you think it's going to go? If we actually think the VIX is going to go now, if we just now let's just kind of say, look, I know nothing, but all I know is kind of when you see some green shading here. Now, if we're seeing some green shading, it does not tell us where it's going to go this afternoon. It doesn't tell us where it's going to go next week. The answer is we don't know, but at least where it is currently. We might say, for example, now Ron actually says sideways. Okay, fine. So I want to kind of take what Ron said for our first trade example. Let's say Ron said, hey, I think it's going to go sideways. Well, let me ask you something here. If you think it's going to go a little sideways, would you want to go all the way out here and put the portfolio, quote, in fifth gear by picking a strategy that is more sensitive to direction? Oh, probably not. Many investors say, James, if I think it's going to be more neutral, if your posture is, James, I'm more neutral, you're probably going to spend more time over here. Now, the one thing I did not say, I did not put this down, is we did not put the married put, the MP married put. Buying the stock, buying the put. If we actually think we're going to be maybe neutral to more volatile, probably going to pick these strategies on the left-hand side. If we actually think, James, everything to me looks like opportunity with my tongue hanging out, if the investor does that, they're probably going to pick long call, long synthetic, stock position, hidey-ho to the upside, and think it's going to go up. They're picking those strategies that are more sensitive to direction. Now, let's say, for example, I thought the VIX was going to go up. So the strategies that we might look at, I'm going to kind of start with an example of a married put. But I'm also going to start with, let's say, looking at where do we think the VIX is going to go. If we think the VIX is going to go up, our watch list that we might look at might be more staples based, real estate based, utility based, and healthcare based. Now, when I say this, I can't buy the group. Okay? I'm buying individual stocks. Why? Because I'm not teaching on Friday. Okay? We're talking about individual stocks now. So what I'm going to do is, so now number one is we could go look in that area and say, are there any stocks that are in the staples, utilities, healthcare, and so on? If I actually looked at, let's say, healthcare just real quick, you're going to notice that healthcare has gotten a little push, yes or no? Well, trying to, right? A little crossover here today, just right in the sectors. Now, what I'm going to do is, if I pulled up a staple-based stock, you're going to see in this case that we got Philip Morris that is trying to get a pretty decent reversal here. Its twin cousin, Altria, is also trying to get a little reversal here, okay? If I looked at, let's say, like a stock, and I'm going to use the example given, like maybe something in the middle here. When I say something in the middle, I'm going to say like, and I'm actually going to go back to Philip Morris for just a second, okay? So when we look at Philip Morris, let's say the portfolio said that it's going to buy, let's say, example given, 100 shares of stock, okay? So what I'm going to do is I'm going to go to the paid money portfolio. Okay, we're going to go to the IRA. Now, this is going to be a trade just for the IRA. Why? Because if we buy 100 shares, it's going to be right at the cap of 10% of the portfolio value. Now, step one, what we're going to do is going to go to the trade tab. And we're going to go to that trade tab, and we're going to type in the ticker PM. Now, if we actually click on, go to the trade tab, type in PM, we go to the ask price. Now, when we look at this chart and say, what is this showing us? It looks like it's kind of trying to show us maybe the start of maybe like a diagonal reversal. Now, someone might say, well, yeah, but I want to see it pull back and make a higher low. Then that's when I'm going to get in, okay? Well, it's funny you should say that. So if we look at this chart, let's go to this second to last chart. Actually, go back, let's see. Let's go about the fourth chart in. And if we go to the fourth chart in, here's our line that we drew, okay? There's the candle. So on the daily chart, keyword daily chart, we actually see that actually price above, and that's no different, okay? What I really want to see, though, is when I look at the weekly chart. This is the same chart. The next chart to the right, you're now going to kind of see that there's a little squeeze. What do you mean by that? Well, you see like a low, and you see really like a higher low. So you can kind of say that on this chart, there's like a little symmetrical movement. We also call this like a W pattern, right? Drop back down, went up to the middle of the W, drop back down, and then in the shorter term, we're making a higher high relative to where we were in the middle. Now, so let's kind of go back. So here's the deal. I don't care. You can throw up any indicator you want. The indicators don't really matter a whole lot unless you kind of have a structure to put them on. That's why we were talking about this now and talking about it tomorrow. So if we take a look at this, how would we actually go back and do this trade, a married put? We already talked about why the focus of a married put. If we're a little concerned about volatility increasing, well, so step one, click on the ask price. So that's not too bad. I don't think I'm going to lose anyone there. Now, step two, when we talk about buying a put, if the stock is at 158, we're concerned about the downside. So if we're concerned about the downside, we're usually going to be wanting to look at, let's say, a strike below the current price of the stock and or what we're actually buying the stock for. Now, obviously on this, we're looking for something that is liquid, usually 20 cents or narrower between the bid and ask. We like to see minimum hundreds on the open interest, okay? Now, in this case, if we got a $3, $3.30 ask price, if we got something in the middle, yeah, that's possible. So I'm going to do the 335 because the example when we talk about buying puts, when we talk about statistical chances, delta, we're saying, hey, look, the chance of the stock being below that strike at expiration is 36%. Okay? Now, as of right now, that it's going to close below that strike by a penny. Now, you also got to recognize something when we say the probability of touching. Whatever the delta is, okay, the probability of touching the stock going down to the strike and then maybe bouncing back up potentially is 75%. So if the investor gets in and sets a stop at 155, what's the odds of them being stopped out? Answer, 76%. That's why a lot of people will say comments like, well, I got in, I got stomped out. Got in, got stomped out. Got in, got stomped out. Well, yeah, probably touching tells us that. The delta actually delta is about half what probability touching is. This is why some people, when the VIX is low, they try to actually buy a put as a risk management tool, then setting a stop. The difference in setting a stop is it doesn't have an expiration. And you're not paying for the stop. You're paying for the put and the commission. Okay? Now, the biggest thing is the put is the right to sell the shares at the strike price from now to expiration. The buyer controls the right to exercise. When you say exercise, what does that mean? The investor can exercise the put to sell the shares at the strike price. Why would they want to do that? One main answer, the stock is probably below that strike, and it's near the expiration and or the put has become valuable. If the put becomes valuable, that tells us the stock has gone down. Now, what I'm going to do in this case is we're going to go single order. First trigger SEQ, click. Now what we're going to do in this case is click on that ask price. When we click on the ask price, what we're going to do is, so first trade for 2026 is we're going to come down and try to get 315. Now, we might put 315 in. It doesn't mean we're going to get filled. We're going to see if we can, okay? Now we're going to take a look at this is we're going to go ahead and say first trade of the year, okay? Confirm and send, buying shares of PM. Now, remind me again, what was the reason why we're going actually kind of the left-hand side? Well, because we're thinking maybe that volatility over the next 2-3 weeks, it might try to go up, okay? And so our first trade example, a little PM. I'm going to put a little PM right there. Not paper money. This is Philip Morris, okay? Now, why do we choose, for example, that married put, buying the stock and actually buying the put at the same time? Same idea. Because we think the VIX might, now, comment was from before, you thought the VIX was going to be flat. Someone actually thinks the VIX is actually going to go down, okay? They might be doing the strategies to the right-hand side. So we're choosing a married put because if that volatility increases, it usually puts pressure on the stock price. We want to have a defined risk to the downside. Now, James, did you always know this? Absolutely not. I would get in when the market, let's say the VIX was all the way down at 10 or 12. I'd finally get in. I'd come in with just buying 10 different ticker symbols of long stocks, long calls. And man, I always felt like I was doing the opposite of what I should have been doing. Okay. Now, you can do whatever you want with this. Okay. But I'm just saying from the learning lessons we've seen, usually investing is the opposite of emotion. Okay. Trade number one, here it is. Now, I want to go actually back to really trade number two. So Philip Morris, buying the shares of the stock and also buying the put. The comment is, can you share that indicator at the bottom of your chart? This chart? Well, if you just want this chart, like all of it, okay, I don't want you to just have this because you're going to want all of it, okay? Let me go back to this just real quick. Let me put this right here. So remember, that link that I'm sending you is not one chart. It's a package of charts, okay? And what you're now going to notice is let's go back to this first chart for just a second, okay? And one of the charts that we're going to look and try to do an example on is AU. Now, AU, you guys and gals know that gold has kind of been a little bullish, okay? And we're going to look at an example. Now, this class is on trading with technical indicators. Well, we talk about technical indicators each week with kind of the same format with looking, let's say, is there an upward trend? So when I say an upward trend, I'm talking about can we visually, if I drop back 1 to 3 months, can we see a trend over the last 1 to 3 months? And I think we could say yes. Shorter term, last 2 to 3 days or 2 to 3 weeks, can we see a shorter term entry in that trend? Well, what might give us a little indication? Well, number one, green on the 10-period moving average. We got that. We got a crossover. We also have the 20-period moving average going green. We just kind of label that 1, 2, 3. Okay? So there's a little crossover here with the moving average. So this is classic entry number 3. The difference between 1 and 3 is One is early, the earliest signs of entry, and 3 is you're saying, I want to get more confirmation. Now, if we take a look at this, what I'm going to do is, let's say the investor said, James, I want to get in, but I'm also a little concerned maybe about if the volatility were to increase. Well, let's go back to this for just a second. Well, if we looked at this and said, okay, what type of strategy might the investor want to be made aware of? We're going to go back to this strategy right here on this left-hand side, okay? So if we look at this on the left-hand side, we're going to want to kind of say, is it possible? And this is where it's very important to start with stocks that are liquid. If you're looking at stocks that trade 30,000 shares a day, it's going to be tough, okay? In terms of looking for trades that actually have liquidity. We're going to go to the trade tab, okay? Now, when we say caller, typically a caller could be a buy right, protect strategy. When you say buy right, protect strategy, what does that mean? Buy the shares, write the call. Protect strategy means buying the put. And you're doing it all at one time. It's like doing a vertical. It's going to look like that on the diagram, okay? But it has a higher delta than a vertical. Why? Because it owns the shares. Now, what we're going to do in this case is we're going to go to the ask price. Ask. And what it does, like before, is it comes down, it really has 100 shares of stock. Now, what we're going to do is when we do that is we're just going to now take step number 2. Step number 2 is we're now going to come down. And in this case, say if I click on the ask price, we got 100 shares of stock, single order, first triggers SEQ. And what is that going to do? Well, it's going to allow us to sell the call and buy the put. Now, we could do this individually or collectively. So if I did this, I'm going to say, look, if we're selling the call is where you want to sell the shares. If you're selling anything, you normally want to sell it higher than what you bought them for. Exactly. So if we bought those shares at 84, we're going to try to sell the shares at 85 or 90. If the investor said, look, I want to be a little bit more bullish, they might sell the 90. And if we clicked on the bid price right there, okay, we're going to try to put that entry maybe right in the middle there. We'd have to see if it fills. Now, if I looked at this right here, I'm going to come in and put it maybe right at about 295, 297. There it is. Now we're going to come to the put side, delta 30 to 40. Again, for buying something, we're going to click on the ask price. Click on the 310. Click on the 310. There it is. And I'm going to click right in that box where it says 310 and come on down. Okay? There it is, 290, 298. Now, when we do that, that is your classic caller. It's going to look like a max loss, max gain. The max loss comes from you have the right to sell the shares at 80. When we say what's the cost of the caller? Well, if you're collecting 297, you're actually paying the 298. It offsets really what the cost is. It's 2 of them. It's coming from the commission, and it's coming from the opportunity cost. What do you mean the opportunity cost? Well, it means you're capped at the 90. Okay, that's what that means. So we really get up from 84.29 up to 90. If you did that math, it's 571. So it's $571 potentially upside from 84.29 down to 80. It's about 429 to the downside. Notice the commission on those, and what we're now going to do is send the order. So I want to kind of say this. When we step back and we kind of say, look, as we go to actually really 2026, you're going to see our portfolio, okay? And one goal that I kind of want to make sure that we always do is I want to kind of really talk about these strategies, and I want to have written plans for those that we could go back and always reference throughout the year, okay? And that way we kind of have, we reset things at the beginning of the year, right now. And then what we also have is a set chart package that we're looking at. We're going to have set strategies and set plans. Now, that's just how I like to do it. Okay, so hopefully you say, James, that sounds extremely interesting. Good, because tomorrow we're actually going to come back with part B of this. Tomorrow morning at 11 a.m. Eastern time. I'm out of my time here today. Cameron May will be up next. But what you can expect from me is we're going to create these plans with these given strategies and then look for the trades that match kind of what we're seeing in the VIX and really trying to put them on when the VIX is high, dropping down, or low and moving up. And that's going to determine what type of trades or strategies that we're really going to be picking. Okay. Now remember that, now was this helpful today? Was this helpful to really get a breakdown like this and kind of reset? But it's also kind of walking through the X and O's of the strategies, okay, and kind of the thinking behind it. Now, remember with what we discussed was done for example, illustrated purposes only. Remember also to subscribe to the Trader Talks channel right on YouTube. And also I will put the playlist in the chat as well. That way you can see our previous classes and keep watching these week after week to kind of see some of the trades we're doing over time to get more and more practice as well. Stay tuned for Cameron May coming up next. Thank you, Rachel, for answering those questions in chat. And with that said, have a great day. Take care. Bye-bye.